So obviously the key question on the minds of investors is how to deal with the current situation. How should they react? Should they react at all? And let's just think back to the global financial crisis. I mean, that would have been a very difficult period to stay invested, but it still would have been, for most people, the best course of action. It's a very difficult time, and we don't know if markets have bottomed. We've seen a strong rebound at the early part of the second quarter. But one of the things that can make it perhaps a bit more palatable for investors to remain invested is looking at valuation, because with the sell-off that we've seen since the back half of February, the valuations of the market are now back to median levels. So we're not at the fire sale levels that we saw at the bottom of the global financial crisis, but we have returned to a level in line with a 30-year median Shiller PE. And the Shiller PE is a measurement that looks at average margins and just kind of it smooths out the variations that you get through these sorts of disruptions. And obviously, earnings are going to be significantly affected through the remainder of the year, but investors will tend to look through that to what happens once the recovery is in place, and the Shiller PE helps do that a little bit more easily than just looking at what nominal PEs might be.
One of the challenges that this virus and pandemic bring is just the amount of uncertainty about the aftermath that it's going to create for the United States, for the global economy. It's really unprecedented in modern times, really, since the opening up of globalization, a pandemic of this scale. And I think that has some profound ramifications for the next 12 to 18 months until we have a vaccine. We could use better international coordination and standardization to improve the situation, but the trends that we had away from those institutions even before the pandemic causes me some trepidation about a turn away from global cooperation in multinational institutions. It also increases risk in some of the lesser developed countries of financial crises. So there is a lot of uncertainty looking ahead, and navigating that is going to be critical.
So the market has gone through a massive repricing exercise, and some of this repricing may have been rational, but much of it likely was not. During March alone, $92 billion worth of debt was downgraded from investment grade to high yield debt. And BBB faces the greatest threat as it lies right on this investment grade versus high yield threshold. And that's an area that we'll be paying a lot of attention to going forward. We've paid a lot of attention to it in the past as well, but it stands to see the largest repricing exercises. And this represents a great opportunity for active management to come in and understand which assets pricing makes sense and which assets present opportunities for investment.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate, so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting www.sextantfunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Sextant funds in a free prospectus or summary prospectus, please visit www.sextantfunds.com or call 1-800-728-8762.